Hello, this is Dave Fehrenbach, and this is my county ethics and individual project on Robin Chopra and his employer Floor. I picked this case basically because Floor Daniels a local firm that I know hold near and dear, and plus they're a giant engineering and construction company, same industry as mine. So I found this case both relevant and fascinating. So getting into the details of the project. Basically, Robin is not a US citizen. He's a UK citizen. He's basically 58 at this time. He's a resident of England. And basically, their version of the CPA is called a chartered accountant, a CA. He was admitted into that in January 11th of 92. Doing a little more research on a CA, it's definitely not more accounting focused like the US. It's more focused on finance, managing, assurance, and audit. So more broad, but not as detailed in accounting. And their registration agency, instead of like it is US, it's called the Institute of Chartered Accountants in England and Wales, ICAEW. They're the firm that does the certifications and does all the testing. And Robin Chopra was never registered as a CPA in the US. Getting into a little more of his background, it's actually pretty fascinating. So this University of Surrey is a high-end technical school in England. And sure enough, he got a biochemistry degree. So not accounting or finance at all. So he got that and graduated in 86. And then there's a pretty big gap on his resume that I was not able to go fill in between when he graduated in 86 and started with Floor in 91. So he clearly went and got some accounting and finance skills after his biochem degree. And then along the way, he got a advanced executive management program from Thunderbird University. So he's actually got a really fascinating global career with Floor. So basically, 10 years as a CFO in Europe, Africa, and the Middle East, the director of finance for one group for 5 years, a short stint as a VP in ops for 2 years, vice president of internal audit for 6 years, a controller for commercial operations in Pacific for a couple years, and then lastly, the group controller and executive vice president from 16 through 21. And it was in the range of 2018 to 20 where things went afoul. Basically, the whole incident and all this is about is how they booked revenue and, accounted for change orders on one bad job. So in particular, so Floor had, they're a construction company. In construction, the main revenue recognition method is called percentage of completion. And it's basically your fixed price construction project. Basically every month you take your percent complete times your bid revenue and margin, and that drives your revenue and margin. So it's very important to have quality staff that knows how to properly recognize percentage of complete methods. And so basically what happened on this Radford job is Floor submitted a bid that was overly optimistic and, basically they bought the job. And after they won the job, they started having massive cost overruns that started worsening over time. So what they did was they turned in change orders to their customer and they were rejected. And that's when things started going wrong for the company. So basically in December of 17 through March of 2019, the relevant period, Chopra, who was both the senior VP and controller and the chief accounting officer for this Floor group, didn't book revenue correctly. So the SEC is claiming he should have known that these financial estimates caused material overstated revenue to be recorded on Floor's books and records. And the result was they overstated revenue and kept the project forecast from a loss position. So further, in support of the foregoing, Chopra directed Radford project personnel to prepare documentation required by Floor's internal accounting controls that Chopra, among others, reviewed and commented on, and which reflected the incorrect revenue estimates and overstated revenue. So they're not only accusing him of doing improper review, but directing staff to not turn in proper work. So therefore, Chopra was the cause of Fluor's failure to maintain the systems and internal controls, and the Radford projects didn't follow GAAP. And these failings resulted in Fluor's maintaining inaccurate books and records, and ultimately Fluor including material misstated financial statements that Chopra signed. And he basically was the cause of these material inaccurate financial statements from the end of 2017 all the way up through March of 19. So basically, in summary, and when all this finished in August of 2019, Fluor had announced a $714 million pre-tax charge stemming from operational strategic review of 16 projects, including Radford. So not only was Chopra's Radford job booked incorrectly, but 15 others were. So prompted by the SEC staff's investigation, Fluor undertook an internal investigation in 20 and identified material weaknesses in its internal control over financial reporting and material errors in its financial statements. And that resulted in Fluor restating its annual and quarterly financial statements for 2016 through 2019 as disclosed in its 2019 Form K refiling and with the SEC on September of 2020 when they had to restart or restate. The material weaknesses identified in the restatement were attributable to partial control failures associated with the Radford project, which resulted in material errors. Throughout the relevant period, Fluor's accounting issues on Radford resulted in material overstated net earnings and Fluor's reporting financial statements. And this project alone, the earnings misstatements were 38 million, 43 million, and 3 million. So basically, a quarter of the earnings in 1 year or 2 years were wrong. They should have been losses and they put in gains. And then the final year, it was understated by 3. So not minor variances here, huge representation errors of revenue and margin. And then another interesting factoid over this is, Chopra was only charged for turning in poor statements and having weak controls. But in my research, I was able to find he sold almost 500,000 of Fluor stock over 9 years. And in particular, he sold 319,000 a single trade of February of 2018. So this is right in the period where this job had tens of millions, if not hundreds of millions of losses, and he was reporting it wrong, and he's selling stock at a profit. So, interesting extra fact, but the SEC did not go after him for that. And then basically what laws were violated. So the SEC's report said it violated sections 13A, 13B, section 2A, 13B, section 2B of the Exchange Act, and rules 13A1, 13A13, and 12B20. So in particular, 13.3A requires issuers with a class of securities registered pursuant to section 12 of the Exchange Act to file such periodic and other reports as the commission may prescribe in conformity with such rules as the commission may promulgate. Exchange Act rules 13A1, 13A13 require the filing of annual and quarterly reports respectively. And then also section 13B2A of the Exchange Act requires an issuer of security registered pursuant to section 12 of the Exchange Act to make and keep records and accounts which are reasonable in detail, accurately and fairly reflect the issuer's transactions and disposition of assets. And then lastly, section 13B2B of the Exchange Act requires the issuer of a security registered pursuant to section 12 of the Exchange Act to devise and maintain a system of internal accounting control sufficient to provide reasonable assurances that transactions are executed in accordance with management's general and specific authorization, and transactions are recorded as necessary to permit preparation of financial statements in conformity with GAAP or any other criteria applicable to such statements, and to maintain accountability for assets. Access to assets is permitted only in accordance with management's general specific authorization, and the recorded accountability for assets is compared with the existing assets at reasonable intervals and appropriate actions are taken with respect to any differences. So that's what the SEC got him for. And then this, following up on, basically not just floors, but gap and SOX issues beyond SEC is, basically this whole issue stems from change orders that were denied by the customer and Chopper and his team putting in probabilities that weren't realistic. So, basically they put in 90 to 100% recovery in change orders, even though they were denied by the customer. So you can get 90 to 100% of your customer agrees to the changes. Once they deny them, you might be getting 30 to 70 cents on the dollar and you're in for a long legal fight. So if they would have properly disclosed those as rejections, which turns them into claims and not change orders, they would have been properly flagged and weighted accordingly. But they intentionally misclassified them and overbooked revenue. And then next is Floor is required to record revenue for unapproved change orders and claims in accordance with SEC subtopic 60535. And Chopper did not follow those guidelines or provide proper evidence of recovery, which led Floor to wrongly categorize claims and revenue. And then their gap POC methods, a project must recognize the amount of entire loss as soon as it becomes evident. So as soon as they knew the job was going to lose, tens of millions of dollars, they were required to book the losses immediately. But instead, Chopper and the team hid the losses and said they're going to get it back in change orders without disclosing they were denied and classifying them correctly. So Chopper helped draft a materially misstated disclosure of pending changes, and the disclosure omitted the amount of unapproved change orders, which are required under GAAP and SEC regulations. And then Chopper also signed SEC filings and a floor management representation letter for multiple reporting periods, misrepresenting revenue. And then at the end of this, floor CEO's quote's pretty great is, dependable estimates and the internal accounting controls that facilitate them are the backbone of POC accounting and are critical to the accuracy of the financial statements that investors rely on. So we'll continue to hold companies and individuals accountable for serious control failures and resulting record keeping and violations. So, basically as the CEO, he's got to trust his team that they're going to follow the rules. And Chopper and the other people on this project most certainly did not. And then finally, the punishment came in a few parts is, just Chopper individually. So pursuant to Section 21C of the Exchange Act, the respondent has to cease and desist from committing or causing any violations and future violations of all these sections we talked about prior. And then within 10 business days, he has to pay a penalty within 15,000. And on top of Floor's punishment, not Chopper's punishment, Floor had to pay 14.5 million. And then 4 other senior executives were also basically fined. So even though this case and the SEC letters about Chopra, you can see there was wrongdoing within the segment. It takes multiple people to, report this kind of losses and hide them. So they all got fined accordingly. And obviously Floors was the largest. And in a separate note, the shareholders sued Floor for the misstatings, and they had to settle with the shareholders for 33 million. That wasn't necessarily all related to Chopra's case because, as I said, there are 16 others. But you can see Floor got a foul with both the SEC internally and their investors. And as far as any other punishments, Floor's headquartered in Irving, Texas at the time of the infractions. There's no record of any punishment with the state of Texas against Floor Chopka. And then since Chopka was not a CPA in the US, there's no records of that here. And there's no record of any infractions on his CA license in the UK. And then basically a status of Chopper now. So this agency we talked about earlier, the ICAEW of Chartered Accountants, you can see he was a member of since 92, says practicing certificate no, and his license has not been dissolved. And his current home base is Woking, UK. So no record of any kind of punishment overseas for his failures internally in the US. And then post-incident, if you go on LinkedIn, there's been no jobs on his profile in 3 years. If you read the SEC filing, basically took a leave in June of 20, and then ultimately was, resigned in February of 21. You go and Google any other job search, any of it, there's nothing on his resume since then. So pretty safe to assume his, major public accounting career ended after this incident. And then just personal thoughts. Like I said before, I'm in this industry and know it near and dear, and go through this every quarter and month. Is revenue recognition in construction accounting can be very difficult, and with the wrong leadership and controls can be easily manipulated. So, basically what that means is if you have a change order, you and your internal lawyers and project team have to make your best reasonable estimate for what you think you're going to get from your customer. And if the customer denies it, booking 90 to 100% is not reasonable. So that's clearly where this team went afoul. And then, also you have to follow GAAP. If you know of a loss, you're supposed to book it, no matter how hard it might be for internal management to swallow. Fortunately, ASC 606 was implemented in 2018, and that helped us get better controls and procedures for RevRec, especially for difficult tasks as quantifying and approved change orders. So there's been better guidelines to prevent this in the future. And then also, like I said a minute ago, Chopra didn't do this on his own. It took, vice president, a CFO, project staff. It took multiple employees to misstate these numbers for, 10 plus quarters. So the fact that it wasn't raised and elevated, it basically showed that Fluor had a internal failure in their internal group for lack of controls and elevating issues that aren't getting solved quickly. And then, basically if Fluor had an internal SOX team and an audit team and financial reviews by licensed CPAs, the revenue rec would not have been would have been flagged and scrutinized far sooner. So basically the team might have gotten away with it for a quarter or two, but that kind of dollars and the lack of progress would have ran up the flagpole, and proper internal reviews would have, figured this, bad job out in 3 or 4 quarters instead of the 3 years it took Fluor to figure it out. And that is it on the presentation. Thank you.